Talk about the impact on government bonds and the banks. Steve Leisman is here to explain. You think this is kind of all coming together at the worst possible time, Steve?
Exactly. While it's not entirely clear, Kelly, what's causing bond yields to rise, it's a good bet. At least part of what's been happening is concern about a possible U.S. default. Yields on 1 month, 3 month, and 6 month bills, they've surged since early May. Some of it could go along with more hawkish Fed talk. We've had leading markets to maybe think the Fed's not quite done yet, but I think more of it coincides with brinksmanship on the debt ceiling. Investors have been fleeing bonds that would be the first to mature if there were indeed a default. Yields have also risen for 2- and 10-year bonds amid concerns, among other things, the U.S. could experience another downgrade. All of this comes, of course, right after regional banks have been through a tough time because, the price of bonds on their books, these very same Treasury bonds, have fallen, creating liquidity concerns. So the debt ceiling hijinks not helping the banking problem, maybe making it worse. The result, since Tuesday, S&P's off 1.1%. Regional bank stocks, however, are down 2.4% amid this renewed pessimism about the sector. Now, the Fed, it could declare, as it did in 2011 in the wake of the S&P downgrade, that there will be no change in the treatment of government-issued debt for risk weights or other purposes at the Fed. That could help, but higher yields could continue to pressure banks if it's actually, Kelly, a loss of faith in the creditworthiness of the United States. How many black check marks do you get?
Right.
And you can keep going and add the full faith and credit.
No, and Steve, your
benchmark.
rates point especially. Stay with us. Let's dive a little bit more into kind of, we'll just call it everything that's been going on and the next steps for the market. Joining me now, David Zervos is Chief Market Strategist at Jefferies. Peter Bookvar is Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. And here in studio with Steve and I is Dan Greenhouse, Managing Director at Solus Alternative. Or is it with Steve and me? Is it with Steve and
with
I?
Me.
Steve and I.
With Steve and me.
Not with I. Wouldn't it be with me?
See, now,
us.
With us.
Now that I have to teach my kids, I realize I have no idea. And the heavy hitters we have assembled here show the degree of seriousness with which we're now trying to treat all of this. So, Dan Greenhouse, let me just turn to you first. It's not that the AAA loss is that relevant per se, but we seem to be heading in without a plan into the deadline here.
Yeah, I mean, I actually disagree somewhat with the position of Fitch, as I did with S&P at the time. I think what you're seeing, not what I think, what you are seeing is the political sausage being made, the proverbial sausage being made. And I don't know why a rating agency would be surprised that the debt ceiling would engender debate among political parties up on the Hill, but and then conversely why you would downgrade the U.S. as a result of that.
But should they downgrade our treasuries because we are now have a 7% one week bill, implying a higher risk of default? I mean, it kind of that from that point of view, it makes sense. They're just responding to the market.
Sure, except listen, the rates forget the 1 month, 3 month, and 6 month bills that Steve brought up. In the next 1, 2, and 3 weeks, let's say. A lot of that is a function of people positioning themselves to just not simply be in the bill that might have a delayed payment.
You're a banker, Dan, and the husband and wife come in and they disagree about whether they ought to take the loan, whether they ought to pay back the loan. I don't know. I might charge you a higher rate because of that, or I might not give you the loan.
And there's certainly a higher rate being charged in the short term.
That's the point. Not just short term, maybe. That's my concern.
What I'm saying is that 7% yield you're seeing in 2 and 3 week bills will go right back to where they should be, quote unquote, when this gets solved. My point earlier about the rating agencies, and just to tie this up, is we have no idea how this is going to resolve itself. Everyone assumes, based on nothing, that they will reach an agreement in the next couple of days. A bill will go through the procedures and it'll eventually be passed into law. When that happens, we will quickly forget about the political debate that occurred in front of that. The end result is exactly what the political process should result in, which is a budget.
Let me turn to Dave Zervos on this. And Dave, there's kind of two springboard reactions that you hear. The one is, stocks are going to rally once we reach a deal because now we can put this all behind us. But the other one, which I think is pretty provocative and interesting, is stocks might sell off in the way that if we had to do austerity in 2011 to reach a deal that was serious austerity, or now if there's more austerity to come in the government budget negotiation or whatever down there, if it's setting us up for, a GDP headwind that is going to be pretty significant, and this is just the beginning of pricing that in. So I know you're going to tell us everything's fine, Dave, but I just want to throw that out there.
Well, Kelly, I'm gonna just make sure you guys put, one other market lens on this, which is that the dollar index today is up almost 0.5%.
True.
So the dollar is strengthening quite a lot. The euro is almost trading on a 106 handle. And everybody I've talked to this year is pretty dollar negative. So this is hurting people. We were 4 figures higher in Eurodollar, and we're pushing big numbers in dollar yen as well. So I kind of differ a lot with what everybody's saying here. I think the stock market's kind of giving you a good read. The currency market's telling you the dollar is more than fine. And the bond market's kind of telling you maybe the economy, the April data has been a little bit better, and the storyline of Fed cuts being imminent or recession being right around the corner is maybe not as clear as everybody thought. I mean, the whole sell side complex seems to have a recession forecasting to start in the next 2 weeks or 3 weeks, something like that, certainly the second half of the year. So I think this debt ceiling thing is actually, I haven't written about it once at Jefferies, and I don't plan to write about it unless something really significant happens. But I really think it's being overplayed in a pretty low vol environment overall in the last month or two.
And you're allowed to take a victory lap on that because you were one of the few people post SVB who said it's not going to be that bad. It's not going to be that big of a deal. But there were a few people shaking their heads while you were talking.